In this downturn with respect to real estate, it's really more capital markets driven. The last big one we had was in the late 80s, early 90s, really the early 90s. And there we had a huge overbuilding problem. We had a lot of empty space. We had a 5-year oversupply. So it was commonly recognized in 1990 that it would take that long to get to a recovery. So that was just to be aware of that was quite painful. This downturn came on very quickly. We got to the end of last year, we really hadn't had losses in real estate. When the real meltdown came in November, it then made its way into capital values in real estate. The refinancing of debt became very apparent. We actually went into a much scarier time period. We had a slow drip in the early 90s. We had a fall off the cliff scenario at the end of last year, the beginning of this year. So, and I certainly don't remember in the early 90s people being afraid of an entire economic meltdown. At least then it was real estate driven and it was real estate oriented. So you might have a lot of your net worth left over here in the other asset classes. This is a refinancing risk as we look at it today, and I think that once we get through this sort of capital markets recovery, we will actually have a faster real estate recovery than we had before. The real estate advisory business actually has gone through a number of evolutions over time. And it usually takes some shocks to have some substantive changes. So a question as to how it's changing or what it will look like, as we come through this downturn is a good question. There will be consolidations, which there always are. Many of the smaller firms, many of the firms that were targeted on very narrow strategies where the tide went out rapidly, and they have difficulty refinancing assets or funds, will not be in business. Many of them are on platforms, like banks or investment banks in particular, where the platforms have weakened and made the decision that the underlying real estate platform, the underlying real estate business isn't compatible with their new business going forward, i.e. the platform went away. So there are a substantial number of firms that will virtually go out of business. Now, on the other hand, and this is actually very similar to, this is like what happens in America and many other places, but certainly in America, there will be new firms that are formed. So the people that have been in this business for a long time, if their platform went away, they're not going to go home and watch television, that I can tell you. They will reinvent themselves. They will form new firms and new businesses and new funds. And once again, we will have a series of firms that consolidated. The consolidators will get larger and more powerful, and new firms will be spawned, which will be very entrepreneurial and very targeted on parts of the business. So there will be operators that become fund managers. There will be fund managers that become operators. So I don't think there's any sort of one description here that explains the world as being dramatically different going forward, but they'll just be different players. Being part of a global organization or being a global real estate investment manager has tremendous advantages. It also has some added complexities. If you're on a global platform, you can partner with your clients and you can execute for them, not only in your home region, but globally. So that, and anytime you can service a client over multi-facets of its business, you will actually have a better chance to grow with that client and to maintain that client relationship. By being able to invest for clients globally, I think you actually have a stronger, more diversified platform and business to operate from.